How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you the differences between a 401k versus an IUL, also known as an Index Universal Life Plan, and why it might make sense to do one over the next, and then kind of, what are the pros and cons of each, and really go and dissect, how to really maximize your retirement plan properly if you're in your accumulation phase. So the first bullet point I talk about is max income. So if you understand the basics of a 401k account, essentially it's a type of retirement plan that's set up through an employer specific to the employee, meaning that an individual would work for a company and this company says, here's your salary, here's exactly how much money you're going to be making, and we're also going to offer you different things with our employee benefits package, such as a 401k account. So you have to think of this kind of like a bucket. Now, each year or each month that this person's working, they could take a portion of their salary and place it into this bucket of money. So the 401k, what that is deeming it is that this money in this bucket, any sort of gains that occur within that type of account are going to grow something known as tax deferred, meaning that any time if this bucket is tied to specific types of mutual funds, well, if this mutual fund performance goes up, you're going to receive a gain into your account. The mutual fund performance goes down, you're going to receive a loss into your account. So each and every year then, individuals placing more and more dollars aside into that bucket, essentially it should be gaining because this person is placing contributions in there, and also the mutual funds that are tied to that specific account should also be increasing, throughout the long haul. Now, what we've seen in more recent years is that's simply not the case with having the guarantees on the mutual fund related side, and the mutual funds do come with certain types of fees, and you could, really get hurt whenever that mutual fund performance does go down. So with a 401k account, though, we understand that this person is placing dollars aside, a portion of a salary, to place it into a bucket known as a 401k, and then this is now deemed for age 59 and a half that this person could then pull money out after age 59 and a half. So if they try to pull money from their 401k account before age 59 and a half, they could be heavily penalized through the IRS and get also hit with full taxation. So the way that this works is when I talk about max income, I say taxable versus tax-free. Now, the amount of monies, the amount of contributions that someone's placing into a 401k bucket, all of those dollars are known as tax deductible, meaning that let's say if somebody makes 100 grand in a given year, $100,000 in a year, and they place $10,000 aside into their 401k account, well, their adjusted gross income at the end of the year is going to show as if they made $90,000 that year. So each year, they're receiving a tax credit or a tax deduction each year that they're making contribution into that account. So what's happening is that this bucket should essentially be growing larger and larger and larger with that power of compound interest, because anytime that there's a gain, well, that interest is just staying compounded within that bucket, within that 401k related account. So if they're having that tax deduction now, that's known as a pre-tax type account. So what happens is you get that tax deduction now, have that tax deferred growth now, to then, after you're age 59 and a half, this person has to pull this money out and it's going to be 100% fully taxable. So when you had years, such in the 70s, the 80s, the 90s, where you had tax rates were much higher than they are today, that wasn't a bad option because an individual would be able to utilize a 401k account, get that tax deduction now during their working years, and essentially realize, say, okay, well, when I retire, my income that I'm going to be receiving in retirement should be lower and the taxes should be lower at that specific point in time, which is true. But now what's happened, and if you look at historical tax rate charts, we notice that tax rates are at all-time lows, and with the economic deficit, the assumptions are that there's going to be increases in taxation throughout the year. So even if, let's say, you're making $100,000 right now, then in retirement you're only going to be making $80,000 or $60,000, whatever the case may be. If you're sitting at a 30% tax bracket right now, because based upon what your income is, but then at retirement, yes, you're making less income, but let's say if increases in taxes, if taxes increase, and now even though you're making $80,000, tax brackets are now at 40%, well, you're kind of shooting yourself in the foot because you're going to need that money, every ounce of that money, or every penny of that money, the most way possible because you're not going to be working in your retirement. So that's some of the different things regarding a maximized income that you have to consider regarding a 401k account, because it's not as easy as, just taking your dollars, throwing into a 401k account, letting it ride in the stock market, and then you're going to have this great retirement at the end of the day, at the end of the year. We've seen hiccups in the market, such as in 2008 when the average portfolio lost 57%. So you had individuals that were in their 50s going into their 60s saying, okay, great, I have $1 million in my 401k account with 500,000 in my 401k account, and then they saw their entire portfolio get cut in half because of this downward market shift through the mutual fund performance and because of the stock market. So that's what this the second portion talks about, which talks about downward market loss, is with the 401k accounts. Yes, you have unlimited growth potential, but you also have unlimited loss potential as well. Just like in that certain scenario with 2008, or if we've seen volatile shifts in the market, and you have individuals that are constantly freaking out, saying, "Oh my gosh, what's happening with my money? Okay, I'm happy one second, miserable the next, because I feel like my retirements, could go down the tubes any second now, any day now." So that's essentially the risk involved with the 401k related accounts. And then also you have certain restrictions like I spoke about before. You have 59 and a half rules, which say that you can't touch your money before age 59 and a half, or else you could get penalized, which is a 10% penalty through the IRS. And then each dollar that you're pulling out is going to be fully taxable on top of that. So, that could be a very large impact. If someone wants to pull out $100,000, well, they're going to get dinged with a 10% penalty and also have to pay full taxes on that money. So also there's something known at age 70 and a half as a required minimum distribution. So it prevents an individual from just holding onto their bucket for too long and never actually pulling money from that bucket to just keep deferring the growth. Uncle Sam wants to make sure that he's receiving his money. So Uncle Sam, hence the IRS, or the government, wants to make sure that they're receiving their money. So that's why they force an individual to start taking required minimum distributions at age 70 and a half. Whether that be 2% the first year, 2.5%, at age 71, 3% at age 72, whatever that case may be, it's an increasing scale to show you to try to pull out that money, because each time that you're pulling out those funds, you have to pay taxes on those money. So because you had that tax deferred growth for all those years, when you start pulling this money out, it's going to be fully taxable. So I hope that all of that makes sense regarding the 401k related accounts. So now it brings me to my next point regarding IUL, and what exactly is that? And an IUL is a type of plan, it's a type of life insurance plan that someone could leverage the cash value inside of to make sure that they could receive tax-free growth on their money, tax-free income on their money, and then also leave a tax-free death benefit in the back end. Now, one of the disclaimers that I have to talk about is 9 times out of 10, anytime I come into contact with with other advisors that tried to set these things up, they're set up the wrong way. So any sort of bad press that you hear about IULs out there, majority of them are justified, because I just think that a lot of agents set them up the wrong way, and what they try to do is put extra commissions in their pocket by increasing their death benefit and not stripping away the different costs. When you set up an IUL plan properly and you're outweighing the pros and cons, it could be set up as a fantastic retirement vehicle alternative. And what I mean by that is the amount of money that you pull out of an IUL plan, it grows tax-free, meaning like tax deferred, tax free. The amount of money that after it comes to a certain point and you want to start pulling this money out, if you do it a specific way, you could also pull that money out tax free. So what do I mean by that? What I mean is basically with a life insurance policy, with a permanent life insurance policy, you have premium dollars that go in. And think of this little egg shape as a life insurance policy, where I guess the charges that are occurring within that account. Everything regarding the dollars that come in are associated with death benefit. Okay, so that means if you have $1 million death benefit and you're paying $500 a month, well, you're going to have higher charges for that $1 million death benefit than if you're paying $500 a month for a $500,000 death benefit. Okay, so if we think of this egg shape, we understand that there's certain charges and expenses versus another thing known as cash value. So if we have that $1 million policy of death benefit, and let's say this person's placing in $500 a month, well, we understand the cost of insurance and all those expenses are going to be taking up a large portion of this egg. Now, anything in addition, let's say if it was $400 for those charges for that year, that additional $100 that was not used up for the charges goes into a secondary portion, kind of think of it as a savings account, and that's known as cash value. So this cash value is going to increase each and every year that you're placing more and more dollars, or you're overfunding this specific type of policy each and every year. So if we kind of think of it like a bucket, and we think of it as an IUL bucket, well, each year that you're placing more dollars above what the cost of insurance is going to increase this bucket proportionately. So that means if we have another type of policy and we're taking that same $500, but now we only have a $500,000 death benefit, maybe now you have cost of insurance is this large, is only about half of how much you're placing in there, and now you have cash value is going to be this much, meaning that for each dollar, if you're overfunding the policy with a lower face amount, with a lower death benefit, well, obviously more dollars are going to go into that savings component, that cash value, because you're going to have less charges. There's going to be less on the company's books, less risk on the company's books. So therefore, it's known as net amount at risk. So therefore, that risk is going to be transferred. By what I mean by transferring that is they're going to have less charges than somebody that has a higher death benefit. Now, let's say if we utilize that same example, but now we're using a $200,000 death benefit with that same $500. Well, now we're starting to see this egg shape look more like, okay, the cost of insurance and the expenses are going to be this large, and now the cash value is going to have a much higher component, a much higher savings account. So when you set up your plan properly, the most important thing is to make sure that you're minimizing that death benefit. Because when you minimize that death benefit, the net amount at risk to the insurance company is going to be reduced, and therefore your charges are going to be reduced as well. So in this sort of situation, what you're doing is you're overfunding. You could overfund something known as an index universal life insurance plan that grows this cash value on a consistent basis by both the savings that you're doing each and every year and then something known as indexing strategies. Now, what indexing strategies covers, this says upward market caps. What an index does is, let's say if you get set up with a specific type of IUL plan, and they're telling you that they have a 13% cap with the S&P 500. So what that means is they have a cap of 13% and they have a floor of 0%. So unlike the 401k account that says, okay, let's say if you invest in the S&P 500 and the S&P 500 grew 20% the first year and then it lost 20% the second year, with that 401k account, you would have gained 20% into your account the first year, and then you would have had your entire account value drop down 20% the second year. If you were comparing it with an index or an IUL type strategy, you would have had a gain of 13% the first year, and once you saw that loss, once it dropped below 0%, that means that you would gain 0% that second year. So therefore, you would have had a plus 13% gain at the end of this year. Over here, you would have had a plus 0% gain, at the end of those 2 years. With that same sort of strategy. So what it does is it gives you a more consistent average to say that anytime the market goes up, I'm going to receive a gain into my account. Anytime the market goes down, I'm going to receive 0% into my account. So with this cash value component, we understand that this cash value is going to grow by the amount of extra dollars in excess of what you're paying in addition to whatever that cost of insurance is. That's what's going to grow the bucket. And then also whatever this percentage return is that comes back is also going to grow the bucket. So if we're having something with like a 17% cap and the market's doing fantastic, well, and we're reducing the heck out of that death benefit and that net amount at risk, well, then what we could do is overfund the heck out of this policy, get exponential growth, and make sure that you're always receiving positive interest on both the savings component and also the interest rate component at the same exact time. So when it comes time to actually pull this money out, you could pull it out in a tax-free manner when done the correct way. A lot of times you have agents that they try to explain it, yeah, as long as you just gank all your money out, as long as you just take a large withdrawal, all that money is going to be tax-free. And that's not the case. You have to play within the terms of that contract. You have to make sure that you're setting it up correctly. One of the other things, so a couple of benefits with this cash value is all this growth in there is going to grow tax-free. All of this money that you're ready to pull out when done the proper way is going to come out tax-free. And then also, because you still have a death benefit, we're leveraging the House of Life insurance. So therefore, you still have a tax-free death benefit that will go to your loved ones as well. Now, out of the hundreds or so different contracts that are typically set up per state, you have hundreds of different contracts or hundreds of different strategies per contract. Typically, there's only about maybe 5 companies that I would ever recommend with IUL plans. One in particular that allows us to really manipulate the heck out of that cost of insurance and all those different expenses so that we're maximizing that cash value as exponential as possible so that when it comes time to retire, you're able to leverage those chips the right way and receive that tax-free growth much better than what would come back in second place or third place. So that's some of the relationships that we have here at Afasia Financial Group. Is we're an independent agency, so therefore we could give you unbiased information. We don't care which carrier comes back in first place, second place, third place. It's going to be whatever carrier is best for your specific situation. If you're in your 20s, 30s, 40s, and you're looking to get set up in an IUL plan, well then there's going to be a specific IUL company or IUL contract that's going to work best for your specific situation. One of the things over here when I said restrictions versus long-term flexibility, these types of products work best if you're trying to leverage it over 10 years. Honestly, I like to see it over 15 years, over 20 years to make sure that you're getting that long-term growth on those specific types of plans. Reason being is because with IUL plans, they're front-end loaded, meaning that your most expensive charges are going to be in the first couple of years because that's when the net amount at risk is going to be highest on the insurance company's books. What I mean by that, if someone's paying $500 and let's say they have, a $200,000 death benefit, well, this person passes away within that first month or within that first year, well, $200,000 now has to come off of the company's books completely tax-free to the beneficiaries. So that's a large risk. So the longer and longer that you're placing premium dollars in there, that net amount at risk is slowly getting squeezed and therefore is getting further reduced, allowing you to have higher cash value growth potential in there. The long-term flexibility is how you want to pull this money out. There are no 59.5 rules associated with this type of account. So I have certain clients that try to shove in a lot of dollars in there and then they want to retire in their 40s. They want to retire in their early 50s and they do not have those 59.5 restrictions. Also with those 70.5 restrictions of required minimum distributions, this is not a qualified retirement account. So therefore it does not have those required minimum distribution restrictions as well. So you do have that long-term flexibility. As long as you're looking to place dollars into the specific type of plan, you could leverage this if you're working for a specific company, and let's say that the company is not giving you a match, or let's say the company is giving you something known as like a 1% or 2% match, well then contribute exactly what the match is up to the 401k account, and then you can leverage other portions into a flexible IUL plan specific with the correct carrier in your area. Now when I'm saying specific with the correct carrier, understand certain carriers allow you to manipulate those charges to your benefit tremendously. So it's not just going into a regular company, seeing some marketing piece either online or a television commercial. You have to make sure that when you're setting up this IUL plan, you're doing it properly. And that's one of the things that we try to help individuals out with. You could, at any point in time, if you found value in this video, feel free to give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service. You could give us a call mornings, nights, weekends, holidays, whatever the case may be, and we'll make sure that there's a specialist standing by to help educate you and see whether or not this might be a correct plan for your specific situation. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and it's because of this methodical process. I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.